Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planner Tim Stearns, founder at TJ Stearns Inc., in your local resource, ladies and gentlemen, for a common sense approach to planning, uncomplicating the financial, the investment, the retirement planning world. He is Tim Stearns. Tim, we always appreciate you being here on the program.
Hey, Peter, thanks for having me.
Always a pleasure. Now, today on the show, Tim, we are going to be talking about some options that are widely debated in the financial world. They seem to either be the best things since sliced bread or never to be considered, never to get close to. Life insurance and annuities. And we'll discuss the different types, the different reasons you may want to consider, the pros and cons, the how, what, when, where, why, a lot of information. So obviously, ladies and gentlemen, stay tuned because we will be covering a great deal of important information for you to consider in your planning. But Tim, life insurance and annuities, are they always bad? Are they always good? Are they evil in some way?
Well, let's start with annuities. I mean, one size does not fit all, okay? But they are a great option to fixed income. When I got in the industry in 1994, the flight to safety was bonds, right? So what we saw, though, for example, in 2008, is that when the stock market went down, bonds went down. So not so much of a flight to safety there. In fact, actually pretty risky. So I like the annuities as a fixed income option for people that are looking for guaranteed income. They have a lot of good nuances to them. Again, not for everybody, but in a lot of cases, it is. I've worked with a ton of baby boomers who really like that option. They're done working. They knew where their check was coming, and now they are getting a payment every month from an insurance company, and they really like that. And it's been proven in psychology tests, surveys, that people that have annuities in retirement are happier because they have their income.
Well, Tim, at their core, annuities are a form of insurance. They are offered by insurance companies. If we look at any other type of insurance, auto, home, liability, long-term care, life, medical, it is a financial protection that we can put in place. Not a lot of people realize it, but you can actually financially protect and put insurance on your retirement income. And
Right.
That's what an annuity does at its core. Its job is to give you safe, guaranteed, dependable, lifetime income throughout retirement.
Right. And one of the things we always do when we're doing an income allocation plan is we explain that to them. If they push back on the fact that we're recommending an annuity, we talk to them about how, well, guess what? Social Security is an annuity. It's the same thing. And the government
Pensions from a company.
Absolutely.
They are an annuity.
And that's kind of what we'll say to them is, we're setting you up for a pension that you would never have had. And the other thing I think is great when you do an income allocation plan for people is to do it based on the couple, right? So that, they understand that when one of them dies, one of the Social Securities will go away. The smaller of the two, but that's still a haircut in income. Well, when we're doing an annuity, we're planning on both of their lives, and it's got cost of living adjustments if the market has growth.
Well, the government, Tim, has said that annuities, in fact, some form of guaranteed income is really necessary right now for the American retiring public, and has promoted the usage of an inclusion of annuities inside of 401k plans. We'll probably see a lot of that beginning and moving forward.
Right. And there's a great article that we can get into people's hands if they want to see it from Ibbotson,
Robert Ibbotson, the economist.
Exactly. Who says that right now he favors annuities over bonds. And why is that? Well, because there's interest rate risk. And a lot of people don't even know what that term means. And that is in our book, Income Allocation. But basically, with interest rates being so low, when they rise, that's going to hurt the old bonds that are out there, right? Because let's give an example. Let's say bonds are at 3% and the new ones are going to be at 3.25%. Americans are going to want the 3.25% ones, the brand new ones that are coming out at a higher rate. So this person holding a 3% bond will actually have to take a loss or discount it to get someone to pick that up from them. And that wasn't the plan. Now I've had people argue, well, if I keep it the whole duration, 3% today is not going to be worth the same thing if you keep it for 15, 20 years. We always tell people, there's a silent thief out there called inflation. Mm-hmm. And, we've targeted at least 3%. Right now, it's a little bit higher because of the Fed printing so much money. We tell them, you got to be careful. You need your dollar to double every 22 years at a bare minimum. So if you're going to hold something for duration, it doesn't work.
Aside from the guarantee of lifetime income that's offered from an annuity, Ibbotson actually points out, Tim, very much to what you've just recalled, is that they can serve to increase the yield. They are not as interest rate sensitive, so they can actually increase the safety of the conservative side of the portfolio, decreasing the risk of loss, and typically with a lower fee or no fee as compared to the internal costs in bond funds or the management of a bond portfolio. So increasing the income, lowering the cost, lowering the interest rate risk. Those are things that it sounds like would improve almost any portfolio.
Right. And that's why, I'd love to get into the hands of the first 10 callers out there, the income allocation book. This is a lot of that information you just shared is in there. And, and this article from Robert Ibbotson is outstanding, and he's been around quite a long time. He's seen a lot. So I appreciate his knowledge. And then our book, coupled with that, really tells a story that I think most baby boomers need to have.
Well, if you would like a copy of that book, Income Allocation, pick up the phone, give a call. Tim Stearns will provide that to the first 10 callers with at least $500,000 saved for retirement. If you meet that criteria, you should absolutely read this essential retirement planning strategy guidebook. Just call now, receive your free copy, 800-640-2256. That's 800-640-2256, 800-640-2256. And Tim, when you look at all of the other options and alternatives that are out there, annuities actually are providing some very attractive features and benefits for the right time and place in the right portion of your portfolio.
I would agree with that. A lot of them offer upfront bonuses or guaranteed growth for income. They're approximate, like I say, they'll offer an upfront bonus on your initial deposit, and then they'll guarantee growth on your value for the purpose of generating future income. Where are you going to find a bond that does that? And I will argue with anyone that that's not a thing. They also do contractual lifetime income certainty. They have income and death benefit flexibility. Some of them even have income with long-term care provisions, where, even if someone is sickly and can't get, let's say, for example, life insurance, they still could use this product within their lifetime. A lot of them have what they call income doublers. So if they're receiving, I'm making up a number here, $3,000 a month, that will double to $6,000 a month, without showing insurability. I don't know of any other product that. The other thing is, and I enjoy this, they have principal protection. That's huge. They're built for safe accumulation over a specific period of time. A lot of people think, well, if I give the money to the insurance company, I'll never see it again. That's not true. If you take let's say one payment and you pass away, your heirs will get the rest of the money. It doesn't go away. And then lastly, a lot of these have fixed interest rates that they offer stated interest rate for a set period of time.
Now, Tim, you mentioned earlier, Social Security, we talked about pensions. Those two forms, when you compare them, those do basically evaporate and disappear if we pass away early. But we're talking about your personal wealth here, and that is not the quality of most annuities today. You are not going to lose control nor lose out on any residual balance there if you were to pass away early or not use up all of your money. In contrast to, say, a company pension, if you pass away after just getting 1 or 2 checks, the rest of that money basically goes back to the company to pay employees that live beyond life expectancies. And same with Social Security. If you do not collect everything that you are entitled to and pass away early, your family does not receive a lump sum of the rest of your Social Security. Stress the importance of emphasizing this with your personal wealth and assets. If you were to create that guaranteed lifetime stream of income that only an annuity can create, you are not foregoing that residual balance. You're not giving up on a legacy or an inheritance.
Right. And a lot of people think, oh, you know, if I put my money in there, I can't touch it for 10 years. That's not true. A lot of them have, most of them have a 10% free withdrawal, they call it. So if I've put a $500,000 out of there, I can pull out $50,000 and it still continues to grow. The rest of the money, let's say the $450,000 in that example, is still growing, without risk in the market. It's going to mirror the market to a certain extent, but it's not going to have risk. And that's all explained in the book.
Well, you mentioned that you like the fact that they can offer principal protection. There are other options that offer principal protection. We could stick our money in a bank, but as opposed to the 0.01% interest that a bank account is going to offer, many of these have some guaranteed growth rates for the purpose of growing and generating future retirement income. Tim, a lot of these are at 6-7% or higher for the guaranteed growth for future retirement income compared to other principal protected alternatives. That is very attractive. And in fact, on average over the last 20 years has compared to returns that investors have received in the market.
Right. We tell people we average between 5 and 8% in our annuities, and that's outstanding for a fixed income product, and it's growing without risk. The other thing we haven't even mentioned, as it grows on the anniversary, it actually locks in those gains. So you will not have if there's a downturn in the market, it will not affect our clients. And I don't think a lot of people understand that.
Imagine that with your money, where you make gains one year and then you can't lose them the next year if the market turns the opposite direction. Tim, there's a lot of people that made good money in the market. The period from 2000 through 2013 had 2 different 100% returns. And if I told you that any 10-year, 12-year period had 2 different 100% returns, you would expect to have a whole lot more money. But between those 100% returns, there were 2 50% declines. Yep. And so we ended that period break even. Whereas if we had locked in the growth each year and then avoided the losses, we would have ended up far ahead.
Right. And we call that the lost decade. It was a little bit more than that, but that's one of the things we talk about in our retirement classes, which are, again, we're back in class at Roosevelt University in Chicagoland area. We're also able to do Zooms for people if they don't want to come into a class arena. So those are the things that we're offering people, and that's the stuff we talk about all the time.
If you'd like to attend one of those upcoming classes, if you would like the book Income Allocation, if you would like to sit down and customize and craft your plan for retirement, your protect and grow plan, pick up the phone and give a call now. Certified financial planner Tim Stearns making those offers and opportunities available to you. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, a lot of people wonder how much they need to retire or when they can retire. Another article from The Street basically proposed that annuities can complete your retirement strategies because they can answer those questions of how much income can you generate and when can you retire. Right.
And these are all articles that we have in-house, that we can get to people's hands via email if they'd like that. It's never too late to learn. I don't care if you're already retired, but a lot of people, they've kind of turned off their ears sometimes because it's been a 12.5-year bull market. And I'm glad that that's happened, that they've done well in the market, but easy come, easy go, as my dad used to say. So that's something you need to be aware of, that, if you don't have a safe money component, things can get really rough in retirement. And that's another thing that we talk about in the book, Secrets of Returns Risk. If you are getting ready to retire, or if you're in retirement the first 3, let's say 5 years, and you have a massive downturn like we did in 2007 through 2009 of 50%, that could be very detrimental to your retirement and absolutely ruin what you're doing. In fact, you might have to go back to work type of thing. And that's why you do a written income allocation plan that you don't have to pull from the market when it's down, because you've already put your money in a fixed income product like an annuity.
Well, it's not until a downturn that we will know if our plan has worked. And that's in contrast, very contrary to the mindset of most investors that are taught to take more risk shooting for higher returns. When those downturns happen, Tim, that can be catastrophic for their plan. Any financial professional or market researcher will tell you that it's impossible to time the market or know when that next downturn is coming. But if our retirement outcome is based on the market and our investments, we are relying on sheer luck of timing that the next several years after we retire will be good ones. And I hear a lot of concern from people right now, Tim, that they're not sure if the next several years are going to be good ones for the market and for the economy.
What we've been learning a lot is we're meeting with people, and they're with different companies that are on TV and that type of thing, and they're supposed to be so great. I'd say 9 out of 10 of them don't have stop losses. I'd say 9 out of 10 of those people don't even know what a stop loss is. And when I explain it to them, they get very anxious because they're like, I don't think I have that, because we've never talked about that. And what's driven in these brokerage houses, that call themselves advisors, and I don't think they are, is that the market is that's where they get their bread and butter. So they have to have you in the market. If you go to cash, they're not earning any money. So it's really about the broker in that example, and not the client. And that's just not how we do things.
The typical investment conversation, Tim, oftentimes has the question, what kind of investor are you? And the broker advisor says, you want to be moderate, you want to be moderately aggressive, because you have to take risk in order to get more return, or for the opportunity for more return. When I think those things are actually separate. We have to look at risk isolated by itself, outside of our need or expectations for returns, because those losses are what is tied to risk. And if we take large losses, if we are uncomfortable taking large losses because we have been pushed and incentivized for return, we may have a very different outcome than we anticipated. Really what that question, bottom line, Tim, what that question is, when an advisor asks you, are you an aggressive or what kind of investor are you, is how much of your money do I have permission to lose for you?
Right.
And that's a very different approach than the income allocation approach that you talk about and that the book details for how to have a more confident, secure retirement.
Right. And that's one thing that we talk to people about, is that, how much can you bear to lose? I had a conversation with a couple the other day in the office, and, he was fine with 25%. And she said, hold on a second. I'm not okay with that. 10% at most. We're going to be retired. Where do we earn this money again? And again, we talk about this in our classes all the time, and with clients. When you retire as a baby boomer that does not have a pension, whatever you had on that last day is all you've got, and you have to make sure that you understand that you have a finite amount of money. You're not going to go out on the tree and pick more money. This is a real thing, and you need to be careful with what little or what a lot you have. It's very interesting to me that people have grown lackadaisical and not really keeping their eye on the ball, if you will, of that this market can correct. And I think they just think it's going to go on and on and on. And at some point, all the money we've been printing in America, that's going to come home to roost. And you're going to need to be aware of that by having stop losses, maybe having a fixed indexed annuity in your, so that you don't need to worry about that.
And certainly having that written retirement income plan that you offer to put together, Tim.
Exactly. And I know that when people leave here with that plan, they feel a lot better.
Well, again, if you would like to get that Protect and Grow, that written retirement income allocation plan in place, or if you'd like to read the Essential Retirement Planning Strategy Guidebook that details how to structure that written income plan for retirement, pick up the phone, give a call. Tim Stearns, your CFP, Certified Financial Planner, Chicagoland. He is willing to help and assist in constructing that plan, reviewing a current plan, or we'll get that book in your hands, Income Allocation. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, you mentioned it's not too late. And in fact, there was a Kiplinger article that detailed the other side of this equation in life insurance and said, retirees, it's not too late to buy life insurance. Are you seeing that there's a time, a place, a reason, and motivation to have life insurance even after retirement and throughout our senior years?
I'm definitely seeing that. And what's really nice is life insurance companies have adapted to what the need is out there. Number one, they're talking about moving the estate tax down to kind of get bigger portions of people's money. Remember, in 2026, that is going to reset down to $5 million, right? And if you have that amount of money, you'll be subject to estate tax. And I don't think people understand the gravity of that. Secondly, there has been talk in Congress about moving it down to lower levels. So if you have that, life insurance would help pay off the estate tax. I always say to people, if they've got that much money, you didn't work your whole life for, to pay the IRS an estate tax. So that's one thing. The other thing is, by taking some money that you might have that is qualified, then you have the ability to do almost like a Roth conversion. And that earns interest within the product. We have a great book for that too. And then lastly, and I think really more importantly, because people are needing this a lot, is the long-term care components, where it actually has living benefits. You do not have to die to use it. A lot of people who are baby boomers say to me, well, my dad paid into it and he never got a penny out of it. Well, that's not how this works. We don't do standalone long-term care products. We just don't. We do products that have living benefits where you can actually pull money out to help pay for your long-term care. 7 out of 10 Americans are going to need long-term care in their lifetime, and 9 out of 10 of them have it.
Tim, as you're mentioning that and talking over the reasons why you would want to consider it, a couple things struck me is that there are individuals out there that can reasonably say, I'm self-insured, and that's a very confident financial position to be in, to be able to say, if I have medical expenses, I'll be able to cover them, no problem. If I pass away, my family will be taken care of and provided based on my assets without any issues or interruptions. And that's a very confident financial position to be in. But your assets are what is providing that confidence. And for a very small price, you could provide additional protection. Your assets provide that security, but even your assets need protection, because that is in fact what provides that security. And for a small percentage of the portfolio value, you could protect that portfolio that is giving you that confidence. And then number two, if you can make that statement and say, I'm reasonably self-insured, then you're probably also going to be subject to those estate tax law changes.
Absolutely.
If you're not now, with the high limit set where it's at about $23 million per couple, when it falls into the future, if you've got that kind of asset level, your assets probably will grow between now and then. You're probably going to be subject to those estate taxes. And I don't know anyone that's got that kind of money, Tim, that wants Uncle Sam to be their largest beneficiary.
I would agree with that. I don't think anyone wants to do that. And you and I have talked about this. Every dollar that you made, you might have had a plan for it. So did the IRS.
Sure did.
So these are things that we need to be cognizant of, things that should be discussed, before it's too late. I had one woman who just got insurance from me, and she found out some life insurance, and she found out that she's got something pretty serious, that she's having an operation on, and she's like, I'm glad we got this under the wire, because we didn't know I had this then. So she's excited to leave perhaps a legacy to her family that is tax-free, when a lot of the money she had was qualified money or taxable when it comes out.
Well, taxes, another big area of concern, hearing a lot about that, Tim. And with either of these options, life insurance, annuities, there is at least the element of control over taxes. You can decide how and where and what type of account to fund inside of an annuity. Lifetime income from any source is fantastic, but lifetime income set up as a Roth IRA to provide tax-free lifetime income would be fantastic. Life insurance also has those associated tax benefits. So control to address and minimize or reduce or eliminate taxes from components of your total portfolio. And that's another advantage, Tim, of considering either of these options.
I agree with you 100%. And a lot of this stuff can be found in articles that we have. I would tell anyone to give us a call and we can get it to them via email. Articles that really serve a good purpose for getting people educated. Because, one nice thing about my father when he was alive is he never stopped learning. And, if you know everything, you don't know everything.
800-640-2256, the number to call. If you would like an individual customized plan and planning strategy session, that Protect and Grow plan, if you'd like to attend any of those upcoming educational events at Roosevelt College, if you would like the book Income Allocation, the Essential Retirement Planning Strategy Guide, pick up the phone and give a call. 800-640-2256. That's 800-640-2256. 800-640-2256. Speak with CFP Certified Financial Planner Tim Stearns. And Tim, we always appreciate your time and the perspective and guidance you provide here on the program.
Peter, thanks for having me.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.